Welcome to Outside the Dollar, a weekly briefing on the economy and the precious metals market. Each week, we break down major financial news shaping gold and silver and the forces affecting your purchasing power. The goal is to make these topics clear and practical without the Wall Street jargon. Today, we have 5 economic signals that, on their own, each raise questions. Together, they form a pattern worth paying attention to. We start with Gary Shilling. He's the Merrill Lynch forecaster who called the 1969-70 recession. Fox Business ran a piece on him recently, and his warning is straightforward. He sees a 2026 downturn driven by a frozen housing market, weakening consumers, and stock valuations he considers stretched. We'll walk through each of those pressure points. Then we look at oil. CNBC reported that U.S. equities are hitting fresh highs as oil prices have surged more than 50% following tensions near the Strait of Hormuz. Markets appear to be pricing in a soft landing. Strategists quoted in that piece are calling it misplaced euphoria. We also cover what softening Treasury demand means for the broader fiscal picture and why investors have historically moved toward tangible assets when that kind of pressure builds. And we close with gold and silver. Gold rebounded this week after touching a 5-week low per CNBC. But the more interesting story may be silver's role across AI, clean energy, and robotics supply chains. Here's what I want you to keep in mind as we go through this. These aren't isolated headlines. The picture gets clearer when you lay them side by side. So, the first warning signal I want to walk through is Gary Shilling, and this name carries weight. Shilling was a forecaster at Merrill Lynch who called the 1969-70 recession. That prediction contributed to him being let go from the firm. Turned out to be right. That track record matters when he says something today. According to Fox Business, in a recent interview with Business Insider, Shilling said a U.S. recession is, quote, almost inevitable by year-end 2026. His view is one warning signal among several, not a guarantee, but this is worth sitting with. So what's driving his concern? He points to 4 things converging at once. First, the housing market. He describes it as frozen. Sellers locked into low mortgage rates from a few years back won't move, and buyers can't afford today's rates. The whole market is seized up. When housing stalls, consumer wealth stalls with it. Second, consumer spending. The American consumer has been carrying this economy for years. Shilling sees that strength fading. Credit card balances are stretched, savings cushions are thin, and the spending that propped up growth is starting to wear out. Third, corporate investment. Companies are pulling back on capital expenditures. Here's the thing, when businesses slow their spending, that ripples through employment and supply chains fast. Fourth, and this one gets less attention, stock valuations. Shilling said directly that stocks are very expensive and a major correction is probably coming. That's not a fringe view. When equity markets reprice sharply, consumer confidence tends to follow. Now, none of these 4 pressures is new on its own. What Shilling is watching is whether they hit simultaneously. That's the concern. 4 drags compressing at once is a different problem than one at a time. And here's where the picture gets harder. Shilling isn't the only voice raising a flag. The consumer he's watching, already stretched, is also sitting in an economy where energy costs just spiked hard. That oil shock is worth spending time on, because the way it moves through an economy is more connected than most people realize. So here's a pressure point that compounds everything Shilling flagged: the Strait of Hormuz. If that name isn't familiar, here's the short version. It's a narrow waterway between Iran and Oman, and roughly 20% of the world's oil supply passes through it. Disrupt that passage, and energy markets move fast. CNBC reported this week that oil prices have surged more than 50% since the U.S.-Iran war escalated. Amrita Sen, founder of Energy Aspects, told CNBC's Squawk Box Europe that markets may be caught in what she called misplaced euphoria. The S&P 500 actually hit a new all-time intraday high of $7,230 on May 1st. While oil was spiking, Those two things were happening at the same time. Here's why that matters beyond the gas pump. Energy is one of those costs that touches almost everything: airlines, trucking, manufacturing, fertilizer, food production. When energy gets expensive, it doesn't stay in one lane, it bleeds across the whole economy. Now connect that back to the consumer Shilling was warning about. A household already stretched thin on housing costs and credit card debt doesn't have a cushion when fuel prices climb. Grocery bills rise, delivery costs rise, heating and cooling bills rise. The squeeze doesn't announce itself with a single price spike, it accumulates. CNBC's gold coverage from Tuesday pointed to something telling. Spot gold was up after a brief dip, but gains were capped. Why? Elevated oil prices are keeping inflation fears alive, and that clouds the interest rate picture. The Fed can't cut if energy is driving prices back up, so you get stuck, a slowing economy that also can't get rate relief. That's a difficult position: slow growth plus persistent inflation plus a consumer with no slack. These aren't separate problems, they're the same problem looked at from different angles. But Shilling and Sen are each looking at one part of this. Dalio has been watching the whole system: debt levels, Treasury demand, political fracture, global conflict, as interconnected forces. That's where we go next. So Dalio's view adds a different dimension to everything we've been tracking. Shilling is focused on the domestic picture. Dalio is zooming out further. His concern is a pileup: rising debt, deep political division, weakening demand for U.S. treasuries, and rising global conflict all converging at the same time. Here's why the Treasury piece matters, because it's easy to gloss over. When the U.S. government needs to borrow money, it sells Treasury bonds. Foreign governments, institutions, big funds, they show up and buy. That demand is what keeps borrowing costs manageable. But if that demand softens, if fewer buyers show up at those auctions, the government has to offer higher yields to attract buyers. Higher yields mean higher borrowing costs, and the U.S. is already carrying a debt load that makes every extra basis point more painful. Think about it this way. You're running a credit card balance that keeps growing, and the bank just told you the interest rate is going up. That's roughly the dynamic Dalio is pointing at, just at a national scale. And he's not alone in flagging this. The warning here isn't that the system collapses overnight. It's that multiple stresses are arriving at the same time. Constretched consumers, energy shock, political gridlock making fiscal fixes harder, and now potential softening in foreign appetite for U.S. debt. Each of those on its own is manageable. What Dalio is saying is, watch what happens when they stack. And historically, when that kind of broad uncertainty builds, investors start asking a different question. Not where do I grow my money, but where do I protect it? Tangible assets have been a consistent answer across different eras. Gold already showed that reflex this week, bouncing back even with inflation fears capping the move. But gold isn't the only metal drawing attention right now. Silver has a story that's worth sitting with, and it's more complicated than most people realize. So where does all of this leave us? Dalio's warning is in the background, and historically, when that kind of broad uncertainty builds, investors have moved toward assets that behave differently than stocks and bonds. Gold started to rebound this week after touching a one-month low. Inflation fears tied to elevated oil prices are keeping a ceiling on the gains, but the dip attracted buyers. Some see that kind of pullback as a potential entry point. What's worth understanding is that gold tends to react to exactly the kind of stress we've been walking through today: debt concerns, geopolitical tension, a Fed with limited room to move. Now, here's what I find interesting about silver. Most people think of it purely as a monetary metal, a cheaper version of gold. That framing misses a big part of the story. Lear Capital published a detailed breakdown of silver's industrial role, and the list is striking. Solar panels, semiconductors, electric vehicles, AI infrastructure, defense technology, advanced manufacturing. Silver shows up in almost every major growth sector of the next decade. And then there's the robotics angle. Morgan Stanley has estimated a $5 trillion humanoid robot market. Projections put humanoid robots growing from around 5 million units today to over 1 billion by 2050. Silver is a key input across that supply chain. India's physical silver demand is more than twice China's right now, and supply deficits continue to draw investor attention. Here's why this matters. Silver sits at an unusual intersection. It behaves like a precious metal when investors get nervous, and like an industrial commodity when the economy grows. That dual nature is rare. China holds a strong position in silver supply chains. The same article from Lear Capital frames that as a strategic tension worth watching, not just a financial one. So the takeaway I want to leave you with is this. When Gary Shilling, Amrita Sen, and Dalio are all raising flags at the same time, that's worth a moment of reflection. Not panic, reflection. Ask yourself whether your savings include any assets that have historically moved differently than stocks and bonds. That's the question worth sitting with this week. That's what we set out to do today. Not predict where things are heading, but recognize the patterns forming around us. Gary Shilling's warning, the oil shock markets seeming to shrug off, gold's uneasy rebound, silver's growing industrial role, each piece connects to the others. The one thing I want you to carry into the week: when multiple warning signals converge, that's when clear eyes matter most. If you're sitting with questions about how to position your savings, Lear Capital can walk you through the specifics. Visit learcapital.com or call 855-271-2873 to speak with a specialist. And if this helped you see the bigger picture more clearly, please leave a review. Thanks for listening to Outside the Dollar. See you next time.